Heyo, what's up? I'm Russ, and we're going to go over the portfolio moves in the month of July. And the reason you clicked on the video is because I did indeed sell the one and only SBUX, which I bought my very first share on November 21st, 2019 at the low price of $83.72. Which is just a shade below where the stock closed as of this recording. So we did hold 80 shares, and as you see on the screen, that was good for about a 22% return. With dividends received, that was probably somewhere over 25%, but since I bought that first share of SBUX in November of 2019, and yeah, look, I bought the second one in February of 2020. Hey, I was still young and new and learning this whole investing game, but I wanted to get my foot in the door and feel like I had ownership of a business that at the time was still growing and doing well. But as of right now, VOO, the S&P 500, had I bought that instead, it's easily up over 100% with dividends received. So needless to say, it has not been that good of a return on that one share of SBUX. We're on simplysafedividends.com here, and we're going to look at a few of SBUX's fundamentals. And by the way, I love Simply Safe Dividends, and you can use them free for 2 weeks. No credit card needed. You just give them your email address. So SBUX has a dividend safety score that they give of 60, borderline safe. And back in 2019, when I had bought those shares, they had a score of 67 safe. And you can see in 2024, it was downgraded to 60, borderline safe because of the turnaround and the struggles that SBUX is going through. They've had 6 straight quarters of declining sales. And I did my own calculations, and the thing that really pushed me over the edge is that their free cash flow payout ratio, which is when you take operating income minus the CapEx, the capital expenditures, you have your free cash flow. And that is what the dividend is paid out of. As you can see, it's further down as a line item. Currently, it's 137%, which is no good, meaning they are paying out way more than they have in free cash flow of that dividend. And this time last year, it was in the mid 70% range. So that, as a dividend growth investor, has made me really nervous. But as we say, you can't buy that dividend. You have to buy the company that is paying the dividend. And SBUX has had really quick dividend growth, but it's been declining. The 10-year CAGR, 16%. The last 5-year CAGR down to 9%, and they raised that dividend last 7% in October of 2024. So they're coming up for another dividend raise, but they've gone 14 years of increasing that dividend. And they do go ex-dividend on August 15th. So if you're new and you don't know how this works, you cannot buy the shares on August 15th. You need to hold them by market open. So just to be safe, make sure you hold the shares on August 14th at market close, and you'll be ready to receive that next dividend, of which should be the last one before a raise. So everyone's going to watch and see what that raise is. And if it's low single digits, I think you're going to have more people nervous and they might start exiting. But based on the 5-year trailing price to earnings ratio, Simply Safe Dividends with this gray shaded area, they take the 5-year trailing price to earnings ratio, and then they go 10% above and 10% below that to give kind of an expected range for the present. And currently they think SBUX is a little bit overvalued at $86.86. And yeah, that's one of the things that bothered me. You can see the forward price to earnings ratio, 35.2, when historically over the last 5 years, it's been about 29. So we're paying a premium valuation for a company that is struggling. Same-store sales have slipped. It's a tongue twister. Same-store sales have slipped 6 consecutive quarters, and that is no bueno. And I don't think we should be paying a premium for that. Now, they did hire Brian Nickel, who's a bit of a rock star CEO, away from Chipotle, where he worked some magic, and he's going to have to be the magic man again, I think, with SBUX here. But I think it was at a very lofty valuation of 35 times price to earnings. So I decided to move on from that because free cash flow payout ratio, as you'll see in a second, is really slipped, and it's not covering the dividend, which the last 12 months shows 123%. But when I looked at the financial statement that was just released last week, I get 137% currently, which Simply Safe doesn't have a calculation for quarterly. But either way, earnings payout ratio, free cash flow payout ratio, both north of 100%. Companies can sustain that for a little while, but it is not a good sign. And there you see the free cash flow. Remember, the dividend is $2.44. And the last 12 months, they only had $1.99 of free cash flow. So not covering that dividend. The earnings per share growth, negative. Sales growth, currently down to 1%. They're barely buying back shares anymore. Total sales look like they're stalling out. And the margins, like return on invested capital, are compressing. This is a metric that shows what the company, what management has been doing with all the money given to it by equity, which is shareholders, and debt. And it's currently starting to slip. It's down to 15%. Their free cash flow margin, 6%. This means 6 cents out of every dollar of revenue coming in the door is making its way down to free cash flow. And remember, with free cash flow, you can pay a dividend, you can buy back shares, you can reinvest in the business, do things like mergers and acquisitions, carry it as cash on the balance sheet. So the higher that number, the better it is. And it has been slipping, and it's currently, other than the black swan year of 2020, 6%. It has not been this low in the last 10 years. But also their interest coverage ratio, I'm a big fan of this number looking at the health of a balance sheet of a company, 7.19. That means they have $7.19 of operating income, or EBIT, earnings before interest and taxes, to cover every $1 of interest on the debt. That's a good number, right? $7.19, but it is not as high as it used to be. Check out 2015. They had $47.50 of EBIT to cover every $1 of interest on the debt, and we're currently down to $7.19. All this taken into account, I'm worried about the dividend, and you can't just hold a company for that dividend, because what have they been offsetting that with? They've been slowly raising prices. And yes, I know Brian Nichols says that raising prices are a last resort, but they have been raising prices. You can't do that forever, because you're going to hit a point where the consumer is just not going to pay that much. They're going to look for cheaper alternatives. So I feel it's like a race against the clock to turn this big ship of a company around before people start bailing on the higher prices. And it's just too much uncertainty for me. So I decided it was time to take my 25-ish% gain, or maybe a little more with dividends received, and exit and buy something else, of which I went heavy last month, buying 80 shares of Zoetis with an average price of $154.27. Now, yes, I think it's been pulled down mostly by the healthcare sector. Yes, Zoetis has had some slower sales and earnings, but I think they're going to be fine. They have a bright future ahead of them. If you don't know Zoetis, they're the largest pharmaceutical company for pets and livestock. We love our companion animals. I was thinking about my cat, Louie. He got sick. If he needs medicine, I'm paying it. I'm not really going to haggle over prices. We're going to get it for him. And that's what Zoetis is the leader in. Of course, there's competition that's going to be coming along. But as people all over the world start to raise up into higher socioeconomic classes, they're going to be getting companion animals and spending on those companion animals, which I think makes them kind of recession-proof, because if my guy Louie, my black cat that I love, is sick and we have a recession going on, I'm going to find the money to get the medicine he needs. We're not going to say, hey, sorry, buddy, you've got a recession going on. You're not going to get your medicine. Which is also a fun thing to think about, that our pets are living longer. So humans are living longer, our pets are living longer, and as they get older, they're getting arthritis, which Librela is one of Zoetis's big pharmaceuticals, is to help our aging pets, especially dogs, that are getting arthritis. And that gave us $160 of projected annual dividend income for Zoetis, the shares we bought. And because I was lacking on specific international stock exposure, I like the dividend bent to that. So we've been buying SCHY, which, if you're familiar with SCHD, the Schwab US Dividend Equity ETF, this is the international version of that. So we've been buying that. It holds about 120, 130 solid dividend paying companies. I like that they don't just buy every company all over the world that pays a dividend. It's a little bit more selective, and this is one that I'm going to build up a couple hundred shares of. So we just hit 100 shares of SCHY, and we bought 65 in the month of July, averaged 27.22. Gave us a projected annual dividend income of $68.25. One share of VTI, the Vanguard Total Stock Market ETF, at 308.72. Again, this is all of the US stock market except some itty bitty teeny tiny volatile companies on the pink sheets and whatever that, without getting into the weeds. It's basically the entire US stock market. And that gave us $3.71 of Patty. One more share of Realty Income at $56.95. Monthly dividend company. They are huge. They're big. Probably not going to grow as fast. So this is in our IRA, and it's a income investment for those growing monthly dividends. Gave us $3.23 of Patty. And then one more share of the MLPX, the Global X Midstream and Energy Infrastructure ETF. It's all your companies like Williams, Energy Transfer, Enterprise Products Partners, Kinder Morgan. These are the companies that operate the pipelines and the infrastructure that oil and liquid natural gas companies use. So kind of cool that they're not really affected by the price of oil because they have contracts with these companies. So as long as oil and natural gas is moving through their system, their infrastructure, they're going to make money. So all in all, in the month of July, we added $238.07 of projected annual dividend income, but we lost a whole lot more than that because we fully exited our Nexstar Media position. And this was another one that I couldn't reconcile any longer because the trends that are coming, not getting any better. They're the largest broadcaster in the United States, Legacy Media, it's also known as. And I just think they are going to struggle to really grow, and they're going to try and buy more and more broadcast stations. And if you think of it that way, it's probably like buying more melting ice cubes. Great company that I think is very well managed, but the industry is just shifting, and I liken it to owning the #1 horse and buggy manufacturer circa 1897. The tides of technology and innovation were blowing, and yeah, it didn't matter how well of a run and managed company they were, just people didn't want to buy what they were selling any longer. So that cost us $372 of Patty. They pay $7.44 of Patty per share, does Nexstar Media currently. But you're probably not going to get a whole lot of capital appreciation out of the share price. There's those 80 shares of SBUX at $93.47. We lost $195.20 of Patty there. And then Vici Properties, 100 shares. That's because we had a covered call we sold in June that expired the third Friday in July. Remember, OpEx, Operation Expiration Date, the third Friday of every month. And that's Vici. They have monthlies. So those were assigned at $32.50. We received 70 cents per share times 100 shares. Remember, every options contract is for 100 shares. So we received $70. That brought our cost break even for that to $33.20. And I've been stubborn, waiting to get it below $32.50. Yes, it did bop there for a little bit. I got greedy and I put like $32.40. I wanted to get a few extra bucks, didn't hit. So I'm going to look to buy in the coming weeks at $32.50, and I'll get back in and capture that full 70 cents per share that we got from that contract that was exercised. So temporarily, that's cost us $173 in Patty, and in mid-September is when they go X. So I have some time to get back in before that next dividend hits, which was a July net loss of $502.13 of Patty. But we got to get to the dividends received first. So really quickly, Vici Properties, $138.40, ticker VICI. Realty Income, $61.60. That's a monthly dividend-paying company. VTI, the Vanguard Total Stock Market ETF, $43.83. Nike paid us $42, which is another turnaround company. Main Street Capital, ticker MAIN, $38.25. But check this out. I keep track of all the dividends I've ever received from Main Street Capital, which has been currently $1,548.56 of dividends and special dividends. So I have this little adjusted tracker, meaning that every time I receive a dividend, I subtract that from my cost average per share, which is currently $37.36. So I've received $10.32 of dividends from Maine. When I subtract that from $37.36, that gives me an adjusted, quote, average share price of $27.04. So that's an adjusted yield on cost of 11.32%. Now, this is not official. This is just my fun way of looking at that and thinking about when I eventually will be repaid, if I hold Maine that long, of my initial buy-in of $37.36 per share. So Maine pays monthly, as well as does Agree Realty, ticker ADC, paid us $26.11, and then we've been holding SOXL, which is a 3 times leveraged semiconductor ETF. This is just a fun little experiment I bought when it was $9.50 back in April of 2025, when the market was falling through the floor on the tariffs and all that. So we were up big on it, but that paid 68 cents of dividends for a total of $350.87 of dividends in the month of July. And to put a nice little bow on this, I'm not going to show you the values because my wife said I don't think we should show exact dollar amounts, but this is hers and mine, portfolio net worth, meaning there's no custodial accounts, no savings accounts, not the net worth of our house, anything like that, just investment accounts with her or my name on it. And we have our 3 mutual funds at the top, and my 401k are the biggest portion of our investment portfolio net worth. Zoetis has become the #1 individual stock. At number 11, we've got cash from those sales. So we're sitting on $8,300 worth of cash that will be invested. So yes, we lost a bunch of patty, but eventually I'm going to be putting that into the market to work, and that's going to grow our patty going forward. But as of right now, cash is our number 11 position. And at the very bottom is SCHY, which currently is number 22. And if you don't know, we are working toward an allocation of 85% in funds because I'm not smart enough to beat the market, although I still want to try. So I'm trying with some of those dividend growth companies and maybe some not, like Harrow Incorporated. They don't pay a dividend. But our current mix is 77.7% funds, 20.6% individual stocks, and 1.7% cash. So again, we're working toward 85% funds, 15% individual stocks, because I still enjoy investing in individual companies and feeling like I have ownership of that business. Because remember, damn it, when you own a stock, you own a little sliver of that company. You actually have ownership of it. And then how that translates into terms of patty, I will show you the numbers on that. The biggest ones, 2 of our mutual funds at I'm pushing $2,000 a year. But all in all, that's good for $9,000 of patty right now. But remember, I got $8K of cash we're going to be investing. We're always DCAing into the 401ks. But currently, check that out. 60% of the dividends come from funds and 40% from individual stocks, which was interesting because remember, our individual stocks are 20% currently. So it's kind of fun that they're accounting for 40% of the dividend income. If you do want to keep tabs on what I'm doing all the time, you can follow me on Blossom. And now, you do not have to download the app. You can just click the link and check out my portfolio in real time as I have it linked to my brokerage, just with Schwab. So you won't be seeing my retirement stuff because they don't offer that feature yet. And I also share everything we're buying and selling, as well as some investing thoughts in the free and fantabulous weekly newsletter. So go to dapperdividends.com, sign up for that newsletter, or click the link in the description below. Now, if you love playing the investing game and you want to get better at it, and you may be playing it wrong, in this floating little box next to my head, I talked with Buffett and Munger unscripted author Alex W. Morris, and he's going to share his thought on how he thinks Buffett would tell you to play the investing game. So if you want to learn that, then click this floating little box and we'll tell you all about it there.